Well, that was an interesting way to start the show.
Hey guys.
All right. Now we're live. Where'd you go?
Right here.
All right. Hey, everybody. Welcome to an all-new edition of What Are Your Thoughts? This is our new official time slot, 5 p.m. on Tuesdays. And I think that's good. Oh, look at you. I think that's good. I think that's good for everyone. The sun is coming out, at least here in the Northeast. And we want to get all the content in, but we want to give people a chance to do what they're going to do after work. So here we are, and feeling pretty good. Apparently, we live in a country where it's illegal to do 34 felonies. I don't know if this is a country I want to live in, but allegedly. Anyway, all right. We have a lot of content tonight, but we have a brand new sponsor that we're super excited about, and I'm going to let Michael tell you all about it. No, it's not.
No. All right. I am super excited. I'm a customer, a user, a wearer. Bird dogs. Oh, it says it right there on the screen.
What are bird dogs, Michael?
Well, it's more than it's a lifestyle, Josh.
Okay.
I don't know what that's about.
All right, you're doing great. Let me jump in. Stretchy fabric.
Stop. I got it.
All right.
They've got pants, as you can see on the screen. They've got shorts that stretch, fit good. But here's the key. I don't know about you listeners, but sometimes in the summer, underwear, sweaty, etc. It's like a bathing suit. You've got liners built right into them, so you can go undie free. Is what I'm trying to say.
Do you have the
built-in
short?
Underwear.
Okay, grown men don't say undies. Do you have the shorts or the pants?
What do you
pants?
say? I have both.
Underwear? I don't know. I feel like what you're saying is very close to panties almost. Like
I've got the joggers.
Okay.
I've got joggers which
what color of the? I think I've seen you wear them. What color joggers?
You have. I've shown you my liner. It's the green. It's like the green teal liner.
Don't tell people about that.
I've got black joggers and I've got like a black and gray like camo shorts.
All right. Let's tell people. Tell people why they should hit the link. What's the promotion? Let's move this along.
The promo code is thoughts, as in what are your thoughts? If you order something, you get a free Yeti, which is
the cooler.
You know what the Yeti is, a cooler.
All right, that's a pretty good offer. So if you hit the link and use our promo code thoughts, you get a free Yeti, and you also get a great pair of pants and/or shorts, maybe a few pairs. All right, I like it. Thanks to Bird Dogs, we appreciate you. Before we get started, just a couple of quick shout-outs. We have June McKinnon on stream. Cliff Peebles is here. Cosmo is here. Rachel is here in the chat. Dr. Doc is back. Zach Lindgren. Dave Airy, everybody's here, the whole gang. I would shout everyone out if I could, but we have way too much to do today.
What is this Bay Eye? Oh, Bay Eye. I got it. Hey, you know what? I forgot one thing about Bird Dogs. They didn't ask me to say this, but I'm just going to say it anyway. They've got a side pocket. You know when you sit on the train and you've got the wallet in your back and it's annoying? Boom. Side pocket for the wallet. You don't have to sit in your wallet anymore.
All right. I don't have a pair yet. I have to see what's going on.
Let's get it on.
What's going on. All right. Inflation is cooling, and we got more evidence of that last week and then today. And stocks are selling off on this news. Maybe you can help me out here.
I disagree. Go ahead.
You disagree that inflation is cooling?
No, I disagree that stocks are selling off on inflation, but go on, make the case.
Oh, so maybe it's something else. First things first, let's do this OPEC cut because this plays into inflation. Crude had a monster day yesterday. I know there was a little bit of a retracement today in the energy stocks, but this was a really big move on the news that OPEC Plus, which sounds like a really great streaming app, is cutting production, a surprise cut. Let's take a look at some of the stocks involved here. Here is Baker Hughes, Schlumberger, and Halliburton. These are the oil services names. Pretty big rallies. These were underperformers pretty much all year and then gained back a lot of ground. Let's look at the explorers and producers. Occidental, which Warren Buffett is buying hand over fist, Pioneer, Diamondback, and Devon Energy. And then the majors, real quick. Exxon, Chevron, ConocoPhillips. So really big rallies this week. I know today they pulled back a little bit, but I still think this is a trade worth doing for people that don't have exposure in the energy space. And Sean put this together for me, so let me just share this. I own the IEO. That's the ETF that owns all of the E&P names. So it doesn't own Exxon, but it owns like all of the other oil and gas companies. Up 4% this week after the OPEC cut over the weekend. Still down on the year. 81% of these stocks are over their 20-day moving average, though, so they're rallying hard. About 44 above their 50-day. And valuation-wise, they're really cheap, Michael. Median PE in this ETF, 5 times earnings. Median forward PE of 7. Median price to free cash flow of 5. And expected earnings growth this year for the group of 10% or greater. So I feel like these stocks have rallied hard this week, but they have a lot of ground to gain, and I don't think we've seen the whole move yet. But that hike in that cut in oil production will eventually feed into the inflation data, and I wonder whether or not the Fed will look past it as something that is largely outside of their control. What are your thoughts?
So you're asking if I think that the Fed will incorporate what this energy, it's not a shock, what this might do to consumer prices.
Well, they can't do anything about it. So will this really have a big impact on whether or not they're...
No, they're not forward looking. They haven't anticipated anything. If anything, they're still backwards looking.
One of the interesting things is that Biden still has not replenished the Strategic Petroleum Reserve. So that's a trade that's still out there waiting to happen. He had sold a large amount of oil. People thought he would cover, meaning buy it back in the 60s. Hasn't done that. Now it's back in the 80s. That's a buy that's still out there. We don't know when they'll do it. They probably won't do it at this price. But I almost feel like that puts a floor under the price of crude because that is a lot of buying. The Strategic Petroleum Reserve is like at a low that we haven't seen in decades in terms of how much oil the United States is hanging on to. I want to touch on PCE. So this is the preferred inflation measure that the Fed follows more closely than CPI. Last week we learned that PCE rose 0.3% in February. The prior month was revised down slightly. And if you want to throw this chart up, John, this is like clear evidence that while it's not happening rapidly, we are definitely cooling. And it was the smallest gain since October 2021 in terms of year over year for this past month. You think that's like significant enough to forestall a May rate hike?
There's a long time between now and May.
Like we could get a lot more. We get a jobs number this Friday.
There's still a lot more data to come out.
Consumer spending fell 0.1%. And what else was I going to tell you? Core PCE up 4 points. I told you that already. I don't know. I feel like things are going in the right direction, though.
Move on to the JOLTS thing. This is interesting.
Okay, so today we got JOLTS report. Let's throw this chart up. This is Bank of America job vacancy to unemployed ratio. This fell to 1.67 in February, which is above the pre-pandemic high, but it represents a gradual easing in the tightness of the labor force. Job openings fell by 632,000 to 9.931 million. So that was below consensus, and I think the first time below 10 million, really probably in 2 years. So that might be significant. You have less job openings, you have less people jumping, and some of these layoffs that were only living in the headlines are now starting to pop up in the actual data.
I'm trying to look at what the market is pricing in for May. Let's see. 60% implied probability of a pause, 40% of another 25. We'll see.
I don't know where that started, but I could picture that trending lower. I don't know. Well, I mean, look, you're going to get ISM, you're going to get all this other stuff, to your point.
These numbers are still so volatile. A day ago, a pause was 42%. Now it's 61%. Like these numbers, the market is still confused. All right, let's move on. Let's talk about positioning, a topic that we've been talking about lately, which Josh accuses this as being a catch-all for everything. But yeah. I think you're being a clown, and let me make the case.
Please.
So this is from Bespoke. What this is showing is that the first quarter of 2023 was the mirror image or a 180 from what worked in 2022. So the first, second, and third strongest deciles of performers in 2022 were all down in the first quarter of 2023.
What are you talking? You're talking about stocks in the S&P 500.
S&P 500. The three worst performers from the three weakest deciles of 2022 crushed it in the first quarter of 2021, particularly the worst decile, which had an average return of 16.8% for the first quarter. Chart off, please. So that's obviously names like NVIDIA, Facebook, like those things absolutely crushed. So let me take you through this, and then you can jump in. This chart is from Bank of America. It's showing the equity sentiment, which slightly worsened. The blue line is what that measures. I guess the green line is extreme bearishness. So when it's not quite extreme bearishness, but people are pretty damn bearish. Bob Elliott did a great blog post on how wrecked hedge funds got over the last week. And what was interesting was not that they got wrecked because it happens from time to time, but they did so when the market was pretty calm. So he says, chart on please, our best estimate of March performance has the industry down roughly 3%, with most of that loss being booked in the last week. This magnitude of losses over this time frame is not unheard of. It happens roughly every couple of years, but it has been unusual to see such weak performance at a time when traditional portfolios have been pretty stable. So why is this important? Next chart, please. He said the magnitude of the underperformance of these crowded trades suggests that an important driver has been hedge funds themselves rapidly degrossing their books in response to elevated uncertainty and counterparty risk. So what this shows is the current exposure to different asset classes in the blue. So stocks are underweight versus the long-term average. Yeah. Bonds are underweight. But then he goes on to say what equity risk they were taking was also very conservatively positioned. Funds were significantly underweight growth stocks, which you see on the bottom pane, large stocks, and U.S. stocks relative to the rest of the world. Then you've got, next chart please, you've got CTA positioning in the S&P 500. These are basically trend followers, absolutely mega extreme bearish, like basically max bearish on the S&P 500. So you've got these people off sides. Then again, the best sector, which was technology and communications. This is from New Edge. You've got the ETF fund flows over a 3-month rolling period on the bottom, with the S&P 500 technology sector on top. And this is XLK, VGT, IYW, and the Qs. So people are running out of tech stocks. And so, okay, what does this all mean? People were not positioned for this rally. Now, maybe the positioning has now gone back to normal, and so maybe the rally will fizzle out. But what if people are positioning for, so they were offsides, and what if they're positioning for a pause? Next chart, please. This shows what happens around the last hike, which is at line 0. With the exception of 2000, look how bullish it is when the Fed pauses. Look at those returns.
What part of this do you think I disagree with?
The positioning is responsible for the rally.
Oh, no, I do agree with that. I just think it's funny that it's the easiest thing to say, though. That's all I'm. Listen,
but doesn't mean it's not true.
No, I agree. I think that when you have a lot of people that very quickly have to get in line with the trend of the market, of course it's going to have an impact. I'm with you on that. I think what's funny though is that it started to be used every day for everything. So like almost to the point of parody, self-parody. So like no matter what was going on, positioning, it's still funny.
I know it's not quite as compelling a narrative as tech stocks are rallying because they have cash, but I like it nonetheless. Speaking of tech stocks, let's move on to your next topic.
Wait,
I have a take.
Wait, are you saying that tech stocks are only rallying because people were out of position? Somebody's fucking buying them.
No.
Who's buying it? The man on the moon?
What?
Somebody's buying them first before people realize they're out of position, and then they buy it and exacerbate that trend.
I think a story that is more compelling for why tech stocks are rallying versus your explanation of cash, although I think maybe there's some truth in that.
They're defensive.
Is more than that. It's more than that. Apple and Microsoft have a ton of exposure to international markets. And think about the headwind that all of these companies got in 2022 from their exposure to the dollar. and foreign markets. This is the exact opposite position. Ben and I were talking on Animal Spirits today. Liz Ann Saunders had a great chart showing companies that have heavily exposure to domestic sales versus companies that have a high exposure to international sales. And there's a major gap with companies that are exposed to international sales outperforming because of the weakening dollar.
I agree with that. Look,
So
the
I think
dollar...
I think that's a big part of the story too.
The dollar was taking away a huge chunk of earnings for every multinational company, pretty much every earnings report last year.
Huge.
So when that reverses, that's like found earnings.
But it
So
did. It did.
I would buy that.
The dollar's 10% off its highs. So not only is it a tailwind from earnings, but also like they're doing more sales. So it's
Also, it happened fast. So
really fast.
Yeah. So listen, I would buy that. I think like most things, there's rarely a simple one word or one sentence explanation that explains a move as powerful as what we've seen in Q1 from enormous tech stocks. I think it's a confluence of events. I think it's like a lot of these companies lapping difficult quarters coming up. None of them had a great year. Tons of layoffs, which the street loves. A lot of cost rationalization. A lot of companies in that space getting back to basics and refocusing on what they do well. Meta was the best performer, by the way, of the group, which is emblematic of what I'm talking about. Then you have the dollar story. Then you have positioning, of course. Nobody wanted to buy them last year, and they started rallying, which makes people have to chase. I think there's a lot going on, but I do believe that the fact that they are somewhat defensive, they have large cash positions, they don't have to roll debt, they're not dependent on small and mid-sized banks. I do think that is partially why people look at them as defensive. And I'm not saying it's the whole answer. So positioning works too. I want to go back to one chart before we move on. John, can you throw this one up with the exposures? Current hedge fund asset class positioning backwards. Okay. So this is interesting to me. So what this is saying is that the long-term average stock exposure amongst hedge funds is almost 60%, and they're about 30% currently. I don't know if it's been more extreme in other periods of time, but for right now, that appears really extreme. But nothing on here really says what they're overweighting. So in other words, if they're that underweight stock, where's the money? Is it all in money markets?
Yeah, good point.
I don't know. I'm not saying the chart is wrong. I'm saying there doesn't seem to be an explanation for what else they're doing. So maybe it's money market and that doesn't show up on there. It's not really considered an asset class, I suppose. Okay, we could keep moving. What are we doing next? Apple, Microsoft. So Barron's did a piece this weekend, and I thought it was interesting, just talking about the March rally and how much of that is attributable to Apple and Microsoft. And this is an undeniable force in the market right now. It's been for a while, but we've kind of forgot about how important some of these stocks are to just what the index does. So Barron's basically says the S&P was up 3.5% for the month, but Apple and Microsoft contributed half of that gain. Apple rose 11.4% in March. Microsoft rose 15.6% in March. Had those two stocks not done what they have done, which is two huge rallies, we would be looking at a down Q1 and a down March, maybe a down March, but definitely a down Q1. So we've seen this before where Apple kind of single-handedly rescues the index. I think we have to agree that that's what happened once again. What are your
100%. 100%.
Yeah.
If you look at the mega caps, like if you looked at the top 20 by market cap versus the bottom 20, huge spread. Huge spread.
Let's look at this one specific day. Barron's notes that on Monday, March 13th, immediately after the government seized Silicon Valley Bank and Signature Bank, signs of panic were everywhere. You had all kinds of regional banks falling out of the sky like meteors. First Republic was down 60% in conditions so chaotic, quote, that trading in many individual stocks was halted as stock exchanges tried to limit the damage. Outside the stock market, government bond yields went haywire. Oil prices fell. The dollar weakened. There were alarm bells going off about the economy and trading desks all over the world. The S&P 500 spent most of that day in positive territory. It ended with 0.1% decline. The only reason that happens is because Microsoft and Apple were holding up. So do we have these charts? Let's put these up. So I mean, look at it. This is a very big deal, and you're talking about 6.2% from Microsoft, and Barron's is showing you 32 companies that equal that.
We spoke about this with Darian on TCAF, that Apple and Microsoft at 13% of the index, you have to go back to the 70s with AT&T and IBM to find two stocks that had a bigger percentage in the S&P 500.
Right, because tech stocks fell. I mean, they're still a big part of the index, but these two really haven't fallen enough to not be as important as they were. Second chart. As one of 11 sectors that make up the S&P 500, the tech industry accounts for more than a quarter of the stock. So it's 29% was the high point in 2021, and it's still about a quarter of. And
by the way, we're not even including like the communications,
like Meta, Amazon,
Google.
Netflix.
No. Amazon's not in there.
Discretionary.
Yeah.
So we're not including that either. We're not including that either, and that's one of these.
All right.
I thought that was interesting.
Yeah, let's keep it moving. All right, so something happened. The Fed did something that they've never done before. Warren Pies, who we had on TCAF, puts out just killer research, so I want to highlight some of this. First chart on, please. This is the difference between the 2-year Treasury yield and the Fed funds rate. Now, most of the time, these track each other very closely. Obviously, the Fed controls the Fed funds rate. The 2-year Treasury is basically the market's expectations of where the Fed funds rate should be. And right now, it's deeply inverted, meaning the 2-year is way below where the Fed funds rate is, meaning the market is telling the Fed to chill out, if not outright cut. So you see a 75 basis point inversion, which is where we're at now. That's that black line. It's rare. It happened during COVID. It happened during the repo crisis in 2019. It happened during the GFC, the tech bubble, when LTCM blew up. You get the point. This happens and then shit blows up. It's not good. And Warren said for the past 40 years, the next Fed move has always been a cut because the market is screaming, stop what you're doing and go the other way.
Yeah, I still
and they
can't
hiked.
believe they hiked.
They hiked. It's the first time ever that the Fed's actions after a 75 basis point inversion of the Fed funds and the 2-year, they hiked.
Can we go back to the chart though? Warren knows this, but I want to say it out loud. This is the first time they hiked after an inversion like this, but it's also the first time that the primary problem that the Fed was facing was inflation. Mm-hmm. None of these other crises were inflation related. Maybe 1990 recession a little bit, but not really.
By the way, the other thing that you see here is that usually a recession follows. Not always, but you had one in 1990. I'm just
making the point that there's an asterisk on this hike, but also there's an asterisk on this particular Fed crisis.
Oh, dude, this whole experiment is an asterisk.
That's right.
Everything that we're living through is an asterisk. But what's indisputable is that after you've had this, stocks haven't done well. When they cut after LTCM, stocks like rallied. That was also the tail end of the dot-com bubble.
Put that up.
Look, next chart, please. Look at the average return. So the dark green line is the average return for stocks after you have an inversion this deep.
Like
That's
flat.
not good. It's not great.
It's like flat. That's not right. That's historically that would be a very bad return.
It's not great.
What made
right.
I wonder what made LTCM the outlier. I mean,
because it was in the midst of the dot-com bubble. That's why.
Yeah, we had like a raging bubble going on.
And so what happened
don't really
was
have one of those right at
like
this
the
moment.
Asian contagion and then the Russian default. That was all out there. We still had the dot-com bubble that we were dealing with. So the hedge funds blew up. We had to save them. Blah 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 blah.
True.
All right, let's talk about the money market bubble. This is interesting.
All right, I don't want to kill this kid because I think he's a good reporter. Jacob Sonnenschein at Barron's, and I read everything in Barron's, and I read this guy's bylines all the time. And maybe it's not his fault, and the editor like made him title the piece this way. I know that's the thing that happens, but this was in Barron's this weekend. The newest bubble is money market funds. I don't love the framing here. Basically, what they're saying is that you have this like rush into money market funds. Let me just read you like a quick piece of this. Total assets held in money market funds, which are investment vehicles that buy cash-like securities, such as short-term treasury bills, recently reached close to $5.5 trillion, according to RBC. That is the highest on record. Earlier this year, money market fund assets stood at $4.5 trillion. So collectively, we've put about $1 trillion into money market funds in just a few weeks. It's the largest increase since early 2020. We know what happened then. The surge came at the expense of bank deposits, which dropped to about 17 trillion from 18 trillion. So it's very clear this is money out of banks into money market funds. And then I guess he's quoting Bank of America. They're saying a net 61.5 billion poured into money market funds this past week, down from 126 billion the prior week. So the decrease is suggesting a potential moderation in bank deposit outflows. But they're still saying the next bubble, money market fund AUM. The implication of saying bubble
bubble has
is
to
that
pop.
somebody's going to like lose a lot of money when it ends.
Yeah.
And that's not exactly how money market funds work or the right way to frame this. What are your thoughts before I share mine? I haven't spoken to you about this.
About what, the nomenclature or just the whole? I don't
Both.
like it.
Both.
I don't like it. I think that, well.
What's the risk? Do you see a risk here? Other than to banks?
There's a huge risk in the sense that this becomes more expensive for banks to fund their operations because they're losing deposits and they're going to have to compete with money market funds. So
is there
that's
a risk,
the risk
in the but when you say
money
is there
market investor risk
bubble?
Is there investor risk? No. This is overnight government paper.
All right, Nicole, turn the TikTok camera on. So here's what I want to teach. Do some teaching. There are two types of bubbles. There are price bubbles and there are activity bubbles. Pickleball is an example of an activity bubble. No one's going to lose any money, but it's clearly a bubble. Scroll through Instagram. Everyone's playing pickleball. Everywhere you go, pickleball this, pickleball that. I don't even really understand what it is, but it's obviously a bubble. But it's an activity bubble. It's not a price bubble. Like the paddle to play pickleball with probably cost the same amount it cost a year ago before everybody started playing. So it's like not that type of bubble. The enthusiasm for money market funds is not driving up the price of money market funds, nor is it setting up for a crash. The money market fund is $1. That's it. It's always going to be $1, no matter how excited people get. It's not going to go to $1.20. It's $1 is $1. That's how money market funds are built. But there is an activity bubble in terms of people being interested all of a sudden in money market funds. But again, does not imply a crash. So what I would say is this. All price bubbles are also activity bubbles. You're never going to get a huge bubble in price where there's not also a huge commotion of people buying, selling, getting involved, telling their neighbor, talking about it at Thanksgiving. Okay. But all activity bubbles are not necessarily price bubbles. Capiche? Are you with me on this?
Can we cause an activity bubble in bird dogs?
We might have. I mean,
they're that comfortable.
Your description was incredible. So we might. I want to make that point. So I don't love the framing of this in Barron's, and I feel like Barron's, of all the publications, has probably historically been the most responsible in terms of talking to investors like on the level and not bullshitting people.
All right,
I don't love the clickbait aspect of that.
I brought some charts that I want to talk through. Jim Bianco has this great chart showing that flows to money market mutual funds accelerated when rates hit 4% last fall and have only increased since. So what we're looking at here, let me just walk you through it. The orange line is the 3-month T-bill yield. The green line is the money market yield. So basically the same thing. The next line are total money market fund assets.
I'm sorry. Chris Hayes is asking, does Bird Dogs make pickleball clothes? Great.
Not yet.
Great idea.
By the way, I don't do pickleball. You're on the verge of playing pickleball. I saw your car last night. You were playing tennis. You were playing tennis last night.
I saw you playing basketball last night.
You should play pickleball.
Defense.
Stop. I'm like Doug Christie in his prime. You should play pickleball. You can't play tennis. You're gonna hurt yourself.
I'm pretty good, but okay.
Chart back on.
What are we saying here?
So for the bottom one is cumulative flows into money market funds. And it says from 0% to 4%, only $66 billion of net new money moved in. I don't know if 4% is the psychological level, but all of the money started before SVB blew up. It was 4%. I think 4% was the trigger.
I was thinking 5, but yeah.
No, it was legit. It was 4. It was 4%.
So at 4% is what everyone was like, oh, screw it. I'm leaving
Yeah.
my bank. I'm going all into the money market.
This next chart from Apollo, who's done great work on this, is awesome. It's showing the inflows into money market funds during Fed tightening cycle, and everything's been gradual except for this current period, which we've discussed ad nauseum, has been a complete outlier. We've never seen a Fed hiking cycle this steep. Balchunas shows the chart of money market mutual funds. It's not just the angle of the slope, but the size too. We know how much they've taken in. 6 times what all ETFs combined have taken in this year.
So when you look at this chart, it clearly looks like a bubble. But again, like the salient point is it's cash, and the price of the fund is not going up commensurate with the assets flowing into it. That's what sets this apart from every other asset class.
Eric says the top 10 money market funds by flows in 2023 have taken in more cash than the top flow getting ETF year to date, which is Qual at $7 billion. So yeah, it's pretty insane. I've got 2 more and then we're going to move on. This next chart shows the deposits at commercial banks versus money market funds. And what I really want you to focus on. So the purple line is money market funds.
Purple versus blue.
The purple. So you saw the blue line is small, is regional banks, and they fell off a cliff with SVB.
Yeah.
But really, the loser is the large banks. Look at the money. Look at the white line. It's just been a slow bleed
It's been gradual, but it's been going on since the end of 21. Look at that.
And so the next chart confirms what I just said, which is small banks deposits fell off a cliff, right, for SVB, but it was the large banks that have been losing, that have been bleeding money to money market funds. Is that interesting?
Yeah, so the thing is that a lot of the quote-unquote large banks themselves do offer money markets, and a lot of times what you'll see, like for example, let's say you had $7 million sitting at Merrill Lynch in brokerage accounts, and you had another, $500,000 or $1 million in cash. You're like a high net worth investor, and you're looking at the cash rate that you're being paid in the bank, and you call your guy. Your guy is your broker at Merrill Lynch, and you just tell him, hey, move $750 into the brokerage account, put it in the money market for now. I don't need it. And like you'll see a lot of that, JPMorgan, Wells Fargo. So you will see flows move into a money market that's still de facto controlled by the bank via their securities operation.
But all of their spread disappears because right now savings accounts are still paying 0 basically.
They make more money if you leave it earning nothing in the bank. I get that.
So now when you move into a money market fund, all their spread is gone. All right. So
yes, I agree.
I think
maybe it's an anti-bubble in bank earnings.
It's an anti-bubble. I think Jamie Dimon's annual letter is the new Buffett letter.
Oh, that's such a great take. I was going to say that. Maybe not today, but like I kind of really agree with that.
So there's a lot in here, but I think it's all really important. And I kept throwing more stuff in. I'm sorry.
Buffett reads Jamie's letter.
Yeah.
I think he said that.
There's just some stuff in here that I want to get to. So forgive me. I'm just going to read from him.
Do it.
All right. So there's a section. He's keeping an eye on all of our competitors. He says the growing competition to banks from each other, as well as shadow banks, fintechs, and large technology companies is intense and clearly contributing to the diminishing role of banks and public companies in the United States and the global financial system. The pace of change and the size of the competition are extraordinary, and activity is accelerating. Walmart, for example, with over 200 million in-store customers each week, can use new digital technologies to efficiently bring banking type of services to their customers. Apple, already a strong presence in banking type services with Apple Pay and the Apple Card, is actively moving into other similar services such as payment processing, credit risk assessment, person-to-person payment systems, merchant acquiring, and buy now, pay later offers. So they've got this chart up here. Next chart, please. A few things that I think are worth paying attention to. Just first of all, global GDP from 2010 to today, it's pretty wild.
That's in trillions.
65 trillion to 90 trillion. Total U.S. debt and equity market, 57 trillion to 123 trillion. I mean, some of the numbers here are insane. But if you look at the bottom with the shadow banks, look at the numbers. Hedge funds and private equity AUM, 3 trillion to 9 trillion. Top 50 sovereign wealth, 3.5 trillion to 10 trillion. Direct credit, 14 to 22. And this is who banks are competing with. Non-bank share of mortgage origination went from 9% to 62%. Just wild stuff in here.
Yeah, the top 50 sovereign wealth fund, AUM, watch that space, because Saudi Arabia is basically the new Silicon Valley. And there's like a two-way love affair happening right now between the Valley venture capital guys and startup founders and the kingdom. And I think this is an interesting thing. It's like, well, what happens when people lose interest in startup investing in the United States? Because all of a sudden the numbers start to not look as good. For instance, like any fund with a vintage from 2012 to 2018 in venture land probably looks amazing. And then everything from 2019 until now probably doesn't look as good. Will U.S. investors lose interest in that asset class, at least temporarily? Well, it turns out it doesn't matter, because the princes are ready to write checks 10x whatever anyone in the United States was going to write anyway. And that's why you're seeing like these little, Saudi investment parties in Miami and shit. That's going to be a really big driving force going forward. And you're going to see a lot more of that kind of cross-pollination. So I think that's an interesting stat in there to watch.
All right, so JPMorgan is crushing it. 5th year in a row, record-generating revenues. They extended credit and raised capital to $2.4 trillion. I mean, just amazing stuff. He talked about the FDIC thing. I think this is really important. I know we spoke about this, but in his words, it's more important than coming out of our faces. He said, to give you an idea of where our taxes and fees goes, in the last 10 years, we paid more than $43 billion in federal, state, and local taxes in the United States, and almost $19 billion in taxes outside of the United States.
Wow.
We also paid the Federal Deposit Insurance Corporation over $10 billion so that it has the resources to cover failure in the American banking sector. That is paid by the banks. However, he said it should also be noted that banks pay for any bank failure as they pay for the whole financial regulatory system. And yes, while these costs are ultimately passed on to their customers, that is true for all industries. The cost is just the price of implementing proper regulations.
Yeah, I think that's directionally right. When there's a plane crash, all of the airlines suffer to some extent because the regulations get tighter, which just means more money. So I think that's true. With the banks, it's just more explicit because they actually pay FDIC insurance into the fund. So
he spoke about how important regional and mid-sized community banks are to the American system, how integral they are, that they do stuff that they can't do, and vice versa. He spoke a lot about AI and how many people that they have working on it, from data scientists to large language people, all that sort of stuff. So he was super bullish on how transformative that is going to be. You have anything to say there?
I'm planning to read this in full tonight. I heard all the sound bites and stuff. But I do agree with you. This has become, I think the Bezos letters were getting there also from Amazon. But yeah, there's got to be somebody that takes the mantle from Buffett.
He's the guy. He's the guy.
Because Buffett's last letter was 2 pages.
It was 11 pages. Oh, was it 2? It was nothing.
It's nothing.
It was nothing.
So somebody's got to talk more about the bigger picture, and I think Jamie's the guy.
So last thing, and then we'll leave it here. He says the recent failures of Silicon Valley Bank in the United States and Credit Suisse in Europe and the related stress in the banking system underscored that simply satisfying regulatory requirements is not sufficient. Risks are abundant, and managing those risks requires constant and vigilant scrutiny as the world evolves. Regarding the current disruption in the U.S. banking system, most of the risks were hiding in plain sight. Interest rate exposure, the fair value of held-to-maturity portfolios, and the amount of SVB's uninsured deposits were always known, both to regulators and the marketplace. The unknown risk was that SVB's over 35,000 corporate clients and activity within them were controlled by a small number of venture capital companies and moved their deposits in lockstep. It is unlikely that any recent change in regulatory requirements would have made a difference in what followed. Instead, the recent rapid rise of interest rates placed heightened focus on the potential for rapid deterioration of the fair value of HTM portfolios and, in this case, the lack of stickiness of certain uninsured deposits. Ironically, banks were incented to own very safe government securities because they considered highly They were considered highly liquid by regulators and carried very low capital requirements. Even worse, the stress testing based on the scenarios devised by the Federal Reserve Board never incorporated interest rates at higher levels. Unbelievable. Yeah. This is not to absolve bank management. It's just to make clear that this wasn't the finest hour for many players.
Yeah, I think his point is well taken. Like, a lot of regional banks, unfortunately, are captive to the people that live and work in their region. And if you have an industry-specific crash like we had in tech company valuations and burn rates and all of this stuff, like, no regulation was going to stop what happened. So people like, where were the regulators? Where were the regulators to police this company's treasury bond ownership? I don't know. It's just not something that we've encountered before. So I don't think it's as much a regulatory thing as it is just like a shitty risk management. But it's not like this company was freelancing and doing weird shit with people's deposits. That would be a whole different can of worms. But that's not the case here. So it's nice to see that in print.
He also was talking about just that it's unfortunate that we sort of settle for just incompetent politicians and people running this country. And just at every level of government, it's just inept. I don't know. He didn't use the words corrupt, but just too bureaucratic. And did he
actually say Elizabeth Warren, or he just?
I don't think he mentioned her, but he's gonna be in the government now.
They've been saying that for 20 years.
Yeah.
I'm sure it's been offered to him every time. Like, every time there's a new president, I'm sure he's on the list. Maybe someday. I don't know why he'd want to. He claims, I saw him speak in person a couple of times.
I was with him one time.
Yeah, and they ask him every time. And he's like, I have the best job in the world.
Yeah.
What would make me give this up to do anything, let alone that? Which He didn't say this out loud, but looks pretty terrible.
Yeah.
So, all right, let's do Make the Case. I'm going to pitch you Newmont Mining. I bought it yesterday. I talked about it on CNBC today.
When's the last you bought a gold miner?
I know. Before I say even one word, let's just make it clear. I don't give financial advice on YouTube. I'm not telling anyone who's watching this to go out and buy or sell any securities. I have no interest in what anyone does. So please don't take this as advice. This is what I personally believe and am doing. Okay. I think the stock's going to work. So it happened to have a great day today that I did not anticipate. But I'm looking at like the price of gold, the price appreciation of gold versus the miners. It's not even close. Like, gold prices have blown the doors off of the miners. Gold got over 2,000 today. Peter Brookvar says that's a 5,000-year high, which I thought was funny. We know that gold has made new highs in every other currency, now making a new high in the dollar. I don't buy commodities. So I bought Newmont Mining, which is the largest, most respected, best managed, highest quality gold miner, pays a nice dividend yield of 3% plus. I think that'll be pretty steady. And the main part of the story here that's worth getting into is that this year is a complete reversal from last year. Look at the chart. Throw this back up, John. You could see that last year was a horrific experience owning this and most other gold miners. And the reason why is the price of gold was falling and the costs to mine gold were rising. And so they got hit both ways. This year is the opposite. Gold prices are making highs and the costs are moderating. So right now, chart off, their all-in cost, I think, is like $1,150 an ounce to like pull it out of the ground and replace it with more reserves. Gold above 2,000 gives them a pretty decent gross profit. And the higher it rises, if they can keep costs low, that should bode well for earnings. Also worth pointing out, there's been huge consolidation in the space. Newmont
is
bought
it still
Gold
in the
Corp.
S&P? It's still it's the only one in the S&P.
I think so. Newmont bought Gold Corp, which was one of its biggest competitors in 2019, and this year Yamana got taken out.
Oh, by
Pan American Silver took the silver, and I think Agnico Eagle, AEM, whatever the hell that's called.
Yeah,
I think
Agnico.
they got the gold. So like there's been rationalization is what they call it in the industry. And I remember this with the airlines. After a couple of big mergers, all of a sudden they started making a lot of money and their stocks took off. I'm not saying that will happen here. I'm just saying that's the backdrop. So you've got less competition, and you've got rising prices and falling costs. So I like the setup.
I hate these stocks.
I know, I hate them too. It's just a trade. Let's do these other charts. This is Agnico Eagle Mines, AEM. It just looks like a reversal of a downtrend. I don't know if it's definitely going to happen, but last summer, fall looks super trophy to me. Let's look at Pan American Silver. Super trophy. Pan American Silver. Silver prices usually do whatever gold does directionally. And then the number one.
Looks good.
Yeah, I don't have a chart of this, but the thing to keep in mind is that you can't like these stocks if you don't think gold is going up. Because while they're not correlated 1-to-1, they're almost all the time positively correlated with gold. So sometimes they're 0.3, sometimes they're 0.8. But
what happened to Silver Wheaton? Remember that one?
Acquired.
Who bought that?
I don't know. Some asshole. No, I don't know.
I hate these stocks. They're so volatile. They're disgusting.
But wait, one more thing. Give me that front month. I mean,
yeah, I'd rather buy gold.
You want it? Fine, but on the equities, would you buy them or sell them?
Newmont. I mean, if I had,
just looking at this.
I'm looking. I'd rather be long than short.
Okay, thank you.
But these stocks are so volatile.
And
volatile.
And the case has been made. Oh, we're being informed by the chat. We're experts in this sector.
Yeah, very much.
Silver Wheaton is now called Wheaton Precious Metals, and the ticker is WPM. Don't follow me into these stocks. I don't know anything about them.
This looks good. Which? But I mean, it just made a huge move. So you can't buy it here, which means you know it's going higher.
Oh, yeah, that's how you know. All right. I don't know anything about these stocks, but I thought it was an interesting trade.
Wheaton Precious, whoever shouted that, looks like a great stock. I don't know.
I have always hated these stocks, if you recall. I always hated them.
I recall. Yeah, I don't like them. Sorry.
I think Newmont, one of the things, they say like 71% or something of their mines are in politically stable regions like Canada and Australia. Like this is not like you're investing in the political stability of Indonesia and good luck.
So I just feel like there's easier ways to make money. That's my opinion.
Oh, that's definitely true.
Okay, let's throw up some mystery charts.
Charts? Multiple?
Charts. All right, so this is a 3-year view. As you can see, Josh, one chart is orange and the other is purple.
Yeah, I'm going to say the purple is Meta and the orange is the FANGs.
Wait, let me just show you the next chart.
Okay.
This is the same 2 lines, except this is over a 1-year period. So chart back, please. So the purple line is outperforming over a 3-year period, and just slightly, and it's demolishing over a 1-year period. There's a 20%. Next chart, please, John. There's a 20% spread over a 1-year period.
Can you tell me if these are? Can you tell me if these are stocks or indexes?
These are geographies. I know I think I did this chart recently, but
Europe is purple. United States is orange. S&P is orange. What is it? Eurostoxx 50?
Eurostoxx 50 is outperforming the S&P 500 over the last 3 years. Anybody believe that?
Nobody knows that. I didn't know that.
And over the last year, it's outperforming by 20%.
Nobody knows that over 3 years, Europe is doing better than the U.S. Nobody really could even guess that because it sounds so improbable given what's gone on there.
I don't even have. How about this? Can't even explain it. It just is.
I can explain it. Positioning.
There we go. There it is. There it is.
Hey guys, if you like today's show, you're gonna love Animal Spirits. First thing tomorrow morning on your favorite podcast platform. New, Michael, and Ben. Make sure you check back in with us at the end of the week for the Compound and Friends.
Promo code Thoughts.
Check out Bird Dogs. Promo code Thoughts. Order yourself something. Get positioned.
Good night.